Everything I'm going to reveal to you. I've been using it for 25 years, and I still use it every day. If you're old, you can get it like the KFC owner did at 74. And if you're young, you have a lifetime ahead of you to get rich. I understood that life is a place where if you don't convince yourself that you're successful even before you become successful, you're lost. That's what successful investing is really about, understanding fundamental principles that don't change over time. 1. Not knowing what you own. The first point, and perhaps the most important, know what you own. I can't believe how many people own stocks and can't describe them to an 11-year-old child in 2 minutes or less. If you ask them why they own this or that stock, they tell you because it's going up, or because my brother-in-law mentioned it. That's the only reason. They have no idea what the company does, what its business model is, or how it makes money. People buy tremendously complicated stories. It's a 1 megabit SRAM COS-RISC bipolar floating AI processor with optimized compiler for point data. If you have a piece like that, I can guarantee you'll never make money. What do you do if this thing drops from 12 to 9? Do you call your friends? Do you walk nervously around the block? What the hell do you do with something like that? I prefer to buy things I can understand. I bought Dunkin' Donuts, Stop and Shop, CVS, and made money on all of them. Sallie Mae, for example, had a very simple story: student loans. If 100 people had analyzed Sallie Mae, I'm convinced all 100 would have bought it. But nobody looked at it, because who wants to lend money to college students? It seemed absurd. However, it was a fantastic, simple story, and it was a great investment. That's the kind of stocks I like to buy. But you'd be surprised how many people, even sophisticated people with financial education, have no idea what the company they're investing their money in actually does. And this is fundamental, because things don't always go well, and you need to know why you're holding an investment when things get complicated. 2. Trying to predict the economy and the market. It's completely useless to try to predict interest rates, the economy, and the stock market. People keep trying over and over again. Of course, it would be useful. I too would love to know when we're going to have a recession. I'd love to know when interest rates will go up or down. I'd love to know when the market is going to rise. It would be wonderful to have next year's Wall Street Journal. Unfortunately, we don't have it. Remember that in 1982, we had a prime rate of 20%, double-digit government bonds, double-digit unemployment, double-digit inflation. Did anyone warn me about this in 1980 or 1981? Nobody. Then, in 1983, they said, well, the economy is recovering. In 1985, they said, we're going to have a recession. In 1986, they said the same thing. In 1987, something happened in October that we all remember now. In 1988 and 1989, they kept insisting, we'll definitely have a recession. And in 1990, we were supposed to have a soft landing, something I've never seen in my life. If you spend 13 minutes a year thinking about the economy, you've wasted 10 minutes. All you need to know is that the market goes up, goes down, sometimes goes down a lot, and that's it. It would be fantastic to know what's going to happen with the economy, but I prefer to deal with facts. If inventories are rising, if copper prices are falling, if hotel occupancy rates are going the wrong way, I deal with stocks, not with predictions. If someone tells you that something will definitely happen in the economic future, you're better off calling the psychic hotline for those things. I've been in this business a long time, and I've found this to be true with Sallie Mae, with Dunkin' Donuts, with Stop and Shop, and with dozens more successful investments. 3. If it's fallen so much, it can't go any lower. This is one of the most dangerous mistakes I've seen. I perfectly remember when Polaroid went from 140 to about 107. People said, if you ever get Polaroid for less than 100, you can buy it by the truckload. The stock broke $100, and people started buying it like crazy. 9 months later, the stock was trading at $18. It happened to me personally with Kaiser Industries when I was an analyst at Fidelity. The stock had gone from $29 to $17, and we were about to buy the largest block ever seen in Kaiser Industries. We bought millions of shares at 15.75, and I thought, my God, the stock has gone from 29 to 17. How much lower can it go? I called my mother and told her, Mom, buy Kaiser Industries. It's at $10. It's down from 29 to 10. How much lower can it go? Well, it went to 9, it went to 8, it went to 7, it went to 6, it went to 5. Finally, it reached $4. Fortunately, this happened very quickly in about 6 months. So I had to admit, I got into this a little early at 15.75. In the business, we call it premature, which is a euphemism for losing a lot of money quickly. The funny thing is that Kaiser owned 45% of Kaiser Aluminium, 59% of Kaiser Steel, 38% of Kaiser Cement, all of Kaiser Electronics, Kaiser Broadcasting, which had 7 television stations, Kaiser Jeep, Kaiser Fiberglass, Kaiser Sand and Gravel, and they had no debt. Nobody has ever gone bankrupt without having debt. So I thought, it can't go to zero. We held on, and 3 years later, the company handed out the shares of Kaiser Steel, Kaiser Aluminum, and sold all the companies. In the end, we received about $55 per share. But if you didn't know the complete story and sold when it dropped to 4, you would have lost almost everything. So never say a stock can't go lower. I saw Taco Bell go from 14 to 1 in 1974, and they had no debt and were earning 60 cents per share. Good companies can fall much further than you imagine. 4. If it's risen so much, it can't go any higher. This is the flip side of the coin, and it's equally dangerous. Philip Morris, adjusted for splits, was selling for 12 cents in 1951 and went to 60 cents in 1961. It quintupled in a decade, and people said to themselves, how much higher can it go? It's never sold at this price. What people didn't see was the cash flow, the expansion to 220 countries around the world, the purchasing power of the brand. The stock increased 100 times more after having quintupled, but many people sold simply saying, how much higher can it go? It can't go any higher. They did the same with Home Depot, the same with Toys R Us. They said, it can't go up more, it's already gone too high. That thinking is extremely dangerous and will make you miss some of the best investment opportunities of your life. 5. They always come back in the end. What a big lie. It's a technical term we only use in the stock market. RCA is about to return to its 1929 price. It never came back. Johns Manville never came back. International Harvester, even after changing its name, didn't fully come back. Western Union, the manufacturers of floppy disks. There are many companies that don't have to come back to their old prices. Some industries become obsolete, some companies are overtaken by competition, some simply disappear. There's no law that says all stocks will eventually recover. It's one of those false securities that people give themselves, but it has no basis in reality. 6. It's only $3. How much can I lose? Let's do a simple math exercise. You buy $10,000 of a stock at $50 per share, and your neighbor puts $25,000 in a stock at $3. If both stocks go to zero, who loses more money? Many people can't answer this question correctly. They think that since $3 is much less than 50, their risk is lower. But if you put $1 million in a $3 stock, you can lose the full $1 million. The price per share doesn't determine risk. What determines how much you can lose is the total amount you invest, not the unit price of the shares. Cheap stocks are not necessarily less risky. They're often cheap for a good reason. 7. It's always darkest before the dawn. This phrase has helped me lose a lot of money over the years. People think that when a business is at its worst, it's the best time to buy. Not necessarily. In 1979, there were 96,000 rail cars in service in the United States. 2 years later, the number dropped to 45,000, the lowest in 23 years. People said, the business is horrible. Now is the time to buy. Then it dropped to 25,000, and people thought, now we've hit bottom for sure. Last year, only 7,000 rail cars were shipped in the United States. The business continued to be miserable, and there was an even greater opportunity to lose money. The same thing happened with the energy services industry. In 1982, there were 11,000 oil rigs drilling all over Oklahoma, Texas, and Colorado. We watched the rig count every week, and the number fell from 11,000 in 1982 to 6,000 in 1983, and then a little lower in 1984. Hundreds of oil service companies, drilling mud companies, downhole work companies, fracturing companies, measuring companies, all of them opportunities to lose money. People said, the business is bad, let's buy these stocks. But the number of platforms continued to fall from 11,000 to 6,000 to 5,000, and 8 years later, it was below 1,000. The industry didn't really start to recover until a couple of years ago. In the textile industry, which I followed in my early days, they have a fantastic expression. It's always darkest before it's pitch black. Companies like J.P. Stevens and West Point Pepperell, founded in the 18th century, which had gone through recessions, depressions, and wars, knew this well. When business is bad, it can get considerably worse. Terrible to the sixth power. 8. When it gets back to 10, I'll sell. This is a classic mistake. Someone buys a stock at $10, then it falls to $6. The investor tells himself, when it gets back to 10, I'll sell and get out without a loss. Let's do the math. From $6 to $10 is a 66% increase. If you really believe the stock is going back to $10, you should be buying more at $6, not waiting to sell. It's a great opportunity with a potential return of 66%. The problem is that people set round numbers as targets. My advice, never set a round number as a selling target. For the next 26 years, stocks will rise to 9.25 or to 8.75, but they'll never reach exactly 10. Set your target at 9.125 or at 8.78, but avoid round numbers. 9. The stock knows I own it. This is one of the most important rules. The stock doesn't know who you are or that you own it. You could be the most wonderful person in the world. You could have helped the Special Olympics, mentally disabled people, the poor, people with AIDS. If you own Bethlehem Steel, the stock will be lower than it was 30 years ago. It's not your fault. People treat stocks as if they were a grandchild or a puppy. They believe the stock knows who its owner is and should behave well because of that. It doesn't work that way. I've seen Con Edison fall 80% and then triple. Public Service Indiana dropped by 90%. Gulf State Utilities has been in business for decades. We had Quality Banks in Texas that went to zero, Quality Banks in New England that went to zero. These were companies that had been in business for 150 years, so don't think you have to have conservative stocks to be safe. I've seen many people inherit stocks and hold on to them because my mother said on her deathbed not to sell Long Island Lighting, but maybe your mother would have realized that the company built a nuclear plant that cost $6 billion more than budgeted, and that Long Island stopped growing. So-called conservative stocks like Eastman Kodak and IBM have fallen 75%. Companies are dynamic. Nothing is completely safe. 10. Look at all the money I've lost by not buying. People do this all the time. I didn't buy Blockbuster. I didn't have Home Depot. I didn't have Toys R Us. In one of my books, I listed 200 stocks just from A to L on the New York Stock Exchange that rose 10 times or more during my management of Magellan. I didn't own any of them, and I still did well. You can't lose money on a stock you don't own. The only way to lose money is to buy a stock, let it fall, and sell it. That's the only way. People cut out the morning newspaper and say, "Oh my God, Microsoft is up $3. I was going to buy 1,000 shares yesterday. I just lost $3,000 while I was sleeping." They do this constantly, calculating losses on stocks they never bought. I like to buy on dips. It's a good rule, but you need to know how to explain it. What is a dip? I generally refer to them in the plural, dips. You never hear about a single dip. It's a technical market term that doesn't have a precise meaning. If it's gone up, I must be right. If it's gone down, I must be wrong. People buy a stock at $10. It goes up to $13, and suddenly, without knowing anything more about the company than they knew at 10, they mortgage their house to buy more at 13. The average movement of a stock on the New York Stock Exchange during a year varies by 50% between its highs and lows. A stock temporarily rising doesn't mean you've made a good decision. Their possibilities are unlimited. This is the classic case of stocks that whisper in your ear. Someone calls you and says, "I want to talk to you about International Bivet." These are always long shots. Companies that still don't have sales, that are going to grow hair, improve your child's spelling, and even iron your pants. But they're missing the most important element: real earnings and current sale. I've tried 30 of these stocks and never made money, not even on one. However, I've made 25 or 30 times my money on stocks like Sallie Mae, MBIA, Fannie Mae, or convenience stores without having any idea they were going to multiply so much. When a stock is worth $3 and has enormous potential, write down its symbol and look at it again a year later. If it's made progress, fantastic, but don't invest until you see real results. The most important thing, the solidity of the business. I've always said I'd like to have a company that any fool could run, because eventually any fool will run it. When I bought Toys R Us, they had the right formula. 4 people in this room could have run it. We wouldn't have done as well as they did, who were spectacular, but we had a great formula, no competition, and we could have gone on for the next 15 years. I want the story to be so solid that if management leaves the next day and is replaced by the next generation, everything will continue to run well. If management can add value, fantastic, but I don't buy stocks just because they have great management. Interestingly, great management always seems to be linked to stocks that have already risen in the last 8 years. There's always something to worry about. This is the fundamental difference in the stock market. Everyone has the mental power to do well, but the question is whether they have the stomach for it. The key organ of the body for investing is not the brain, it's the stomach. There's always something to worry about. In the 1950s, people were terrified by another Great Depression and by nuclear war. They built air raid shelters and stored canned food. They weren't buying Minnesota Mining or Xerox. Yet the 1950s were the best decade of this century for the stock market, except perhaps the 1980s. In the 60s and 70s, it was the Cold War. In the 80s, inflation. There's always something to fear. I think the younger investors are, the better they do, because they haven't heard about all these previous crises and aren't as scared. If you have children, ask a 7-year-old if they know about the money supply or the shape of the yield curve. Children have very high expectations for the next 20 years. The further you get from this mindset, the more you read alarmist things, the worse you invest. I have no idea when the market is going to fall or when it's going to rise. I was very surprised to see the market at 4,000 a year and a half ago, but I guarantee you the market will be much higher in 15 years and much higher in 25 years. What will it do in the next 1 or 2 years? I have no idea, and I don't care. What I do know is that in the last century, the market has fallen 10% or more 53 times, approximately every 2 years. It has fallen 25% or more 15 times, approximately every 6 years. That's what we call a bear market. It's going to happen again, and I don't care when. Corporate earnings will be much higher in 8 years, much higher in 16 years, much higher in 30 years. When you sell a stock, it should be for the same reason you initially bought it. If that fundamental reason changes, you move on to something else. On diversification. I don't believe in diversification. I would have a single stock if I could find the perfect one. People buy one thing thinking it will balance another, and both go down. I don't believe in that at all, but I do believe in this. If you find 10 good stories, all equally attractive, buy all 10 and wait to see how they develop. It's like watching 10 poker games and observing how the cards turn. Story 3 improves, Story 6 weakens, Story 7 stays the same, but rises 50%. I sell 7 and buy more of 3. That's how it works. You keep monitoring the 10 stories, and magically, by that rule that stocks go up and down a lot, you have opportunities to buy more of the best ones when they temporarily fall, or you sell when a story deteriorates, but the price doesn't yet reflect it. This approach gives you great advantages because something always happens with companies, or the market falls and all stocks drop. It's like being in the fifth inning of a baseball game while others are in the ninth. Today's market is no different from the market 50 years ago. The only difference is that now we have more data and information, but the fundamental principles remain the same. And that's it for today's video. If you learned what you needed, subscribe to learn more about investments.